following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and we're talking about money. There's a book out that's called Buying Slow, Selling Fast. It talks about investors from retail do-it-yourself investors to professional money managers, people who do fundamental analysis of stocks. They take a lot of time studying what to buy, how to buy it, at what price to buy. They spend a lot of time doing that, and usually they make some pretty good decisions. But most investors, whether it's top professionals or whether it's retail do-it-yourselves, spend a whole lot less time on deciding what to sell. It's all about the approach and understanding what goes on once you buy a stock. Al's got tremendous insights on some of what goes on that investors should be aware of. So that's coming in the program. Also coming in the program is that Adams Financial Concepts clients got hit pretty hard in 2022. More than the market. We were down more than the market. That happens every so often. We recover pretty well. And it wasn't just that our clients were up 45% in 2019 and 77% in 2020. It wasn't a reversion to the mean. It wasn't coming back to an average. No, there were 9 factors or events that happened, at least 9. And what happened and how that affected us also comes to explain why in the 12 months following the low, we're up 48%. That's not bad in 12 months. And it continues. But let's begin. Al, you've got some great insights.
So, Mike, let's talk about a guy who just died this past week. His name was Angelo Mozilo. You'd probably know him better as the CEO of Countrywide Financial, one of the 25 companies that they say precipitated the collapse in 2008.
Yeah.
They were the largest originator of mortgages in the country. They had a heck of a good business. They were underwriting. The 2 guys, David Loeb and Mozilo, started this company in 1968. They started with fundamentally underwriting good risk.
So what happened?
Well, as they got bigger and bigger, they became the number 1 originator of mortgages in the country. And Mozilo was obsessed with staying number 1. So a little thing happened in the early 90s when they relaxed regulations on mortgages. And they started to come out with these things called 1-year ARMs, 7-year ARMs, 10-year ARMs, and creative designing these type of products that could fit different scenarios. Yeah, and there's nothing wrong with an ARM. Don't get me wrong. There's nothing wrong with somebody saying, I was advising my brother the other day. He was trying to sell his place and buy a new place. And I said, well, interest rates are high, but interest rates will probably come down. You could rent your current place and use an ARM. And then when interest rates come down in maybe 3, 4, whatever years, you could refinance and be net neutral. And so it's not a bad product. But what happened was they started eroding the underwriting that was underpinning the business. And they started to see in the early 2000s that the delinquency rates went from 10% to 34%.
Wow.
But they were obsessed of being the number 1 mortgage originator in the country. And they did that to the detriment of their collapse. And what we all know is the great financial crisis of 2008.
And the shareholders lost everything.
They lost everything. And companies, they asked for bailouts. I think it was Bank of America, and they got $2 or $3 billion. And they thought he was in contact with, I think I haven't read the book, but Geithner, who was the Treasury Secretary, thank you, at the time. He had several conversations. Geithner's like, I've never met this guy before in my life. And all of a sudden I'm having several conversations with this Angelo Mozilo. And he thought, well, they should help us out. And, of course, they didn't get helped out. They got helped some money for some banks. But it's a classic case, Mike. Short-term thinking over the long-term progress. Had they stayed doing what they were doing and left their subprime mortgage business where it was at about 10% and delinquencies at about 10%, company-wide would have been fine. He probably would have came through the great financial crisis. They probably still would have been number one when things picked up again. His business would have just taken off for him again, all the way because the housing market took off again after that, after things. He probably still would have been in great shape.
But they changed their strategy.
But they're not the only ones, Mike. This happens a lot. This is not like, you just spoke in the beginning there about people spend a lot of time studying companies and then study a long time and then buy these companies. But they spend a lot of time after they buy the companies looking at what's going on and analyzing that. Are they making changes to their fundamental strategy? Are they switching from a long-term strategy to a short-term strategy?
And there's a real push on most public companies for quarterly earnings and quarterly revenues.
And, Warren Buffett's always trashed that and said that, who cares about quarterly? Everybody can have a bad quarter, right? A baseball hitter can go 10, 12 games without base hit, right? But then all of a sudden he breaks through his slump and gets right back to where he was.
Mm-hmm.
So anybody can have a bad quarter, but, these companies like Countrywide that focus just on trying to stay number one at the behest of trying to be long-term number one, it's a detriment.
It is a detriment.
And we, like you and I spend a lot of time looking, and we watch the companies, and we listen to the quarterlies, and, we're not so concerned about a CEO who's sticking to his guns long-term and says, oh, things could be rough, well, we might have this, and then, you and I will see the stock trash, even though sales are good, revenue's good, and it gets hammered. We're like, okay, but the guys in the management is sticking to their long-term strategy. You're not worried about tomorrow, next week, and the week after. You're worried about 5, 10, 15 years down the road is what you want them to be concerned about.
And some of those companies that have changed strategy don't exist today.
Yeah. There's a list of them. I mean, we can just go recently to SVB Bank, right? I mean, They focused on return on equity for their executives, and that was their way they compensated themselves. And so holding long-term bonds over short-term when they should have been in short-term bonds caused the demise of the company.
It caused a big demise of the company.
Yeah,
and all sorts of issues nationwide.
Yeah, exactly. And it precipitated this other, what was the other one? First
Citizen?
What was the other bank that collapsed?
Republic.
First Republic, right? It precipitated that collapse. And then there was all this speculation that we're going to have a regional banking crisis. And we don't really see that happen. Oh, there could be another bank out there that has some issues, but we don't really see that happening.
But because investors, professional money managers, didn't see Silicon Valley Bank happening, then they suddenly ascribe all those characteristics to every other bank and begin to downplay everything else. Banks that are completely solid get hammered down.
Yep. But there's other stories of story of Briggs and Stratton. They had the market share. They had the lion's share of these small lawnmower and jet skis and those type of engine. They made a heck of a good product. They didn't break down. If you bought a lawnmower and what kind of engine it had, who cares about the lawnmower, right? It was all about what engine. If it had a Briggs and Stratton, that's
I
good.
remember the Briggs and Stratton engine on the lawnmower.
And
I hated them on the lawn, but I remember the engine.
Yeah, and you knew it wasn't going to quit, so you're like, dang it, I don't care what happens to it. Couldn't kill it. But the old man that started it, he was a manufacturing guy. He started from the bottom up. He knew the product, how it was built and how it was put together and packaged and sold, and he knew all the nuances about the product. When his son took it over and came back and took it over, he was out of private equity. And then the other partner was out of, he was an accountant. He was out of banking and accounting. And so they only focused on short term. They started cutting costs. They weren't taking the advice of the people who were building the product. And then the Walmarts came in and could sell you a $129 lawnmower. And so their short-term thinking just put them right out of business, and the stockholders lost,
And the stockholders should have been aware when the management changed?
Yeah, and the thing is, Mike, it was gradual, right? They started having union problems and fighting and negotiating and bargaining with the union, and they started really trying to beat the union up over cost and everything like that. And he could see that management was really starting to cut in ways that wasn't going on before that, and it slowly just precipitated the decline of the company.
And for a lot of investors, you look at that and you think they're cutting cost, they're making the company more profitable.
Yeah, that's right.
The stock price is going up.
Mm-hmm.
Things are really good.
Yep.
What they don't realize is things will turn soon.
Well, there's cutting cost and there's cutting cost, right? There's cutting fat, that's waste.
Yeah.
Like everybody gave Amazon and the tech companies a bad time when they were laying people off. But you and I know, because we know people that they do this every year. They go through and get rid of people. They look and they do an analysis and say, we don't need this, we don't need that. And, Microsoft in particular does it, and they laid off what I don't know.
They do.
But the stock is up 30%, but their profits are up. They're not cutting necessities and cutting things that they know what they need to do. They're just trimming fat.
Yeah. We had a program not long ago talking about another company that changed when they merged with McDonnell Douglas.
Yep.
And the focus was on cutting cost, cutting safety.
Yep.
And of course, the story was the 737
Yeah,
MAX.
the book, if you haven't read it, is Flying Blind. I can't think of the author, but if you want to read it, it's a great read. It really is, and interesting and fast read too. But yeah, when they focused out away from being like Briggs and Stratton, when they focused, right, we're engine makers, and and Boeing in the early days it was all about the plane. When they turned to all about the quarter, that
down they went.
Down they went, right, and that's where the problems come in. So we'll pick this up as soon as we get back. We got more of these stories to tell you. They're all a little bit different. So just hold on, and we'll be right back.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So, Mike, another story like this, and it's not about cost cutting. It's not just about, they didn't lay anybody off. They didn't change focus. They just missed where the market was going. And it was right in front of their face. And it was Blockbuster. When they grew, I forget how many stores they started in like 1995 and grew to how many stores they ever grew to. 9,000. It was 9,000 stores.
Mm-hmm.
But then this little thing popped up around called Redbox, where you could just order the movie and save it online and go up to your 7-Eleven or your nearest store and pick up the movie. And they were $1.99, so it was cheap.
Yeah.
And then this little company Netflix came along, and they had the opportunity to buy Netflix. Not once, not twice, but like 3 times. They got the opportunity for $50 million in like 2002, 2003 to buy Netflix. And they didn't think that was the way to go. And they passed on buying Netflix.
It wasn't their business model.
Yeah.
And what they didn't realize is there was a change in lifestyle and demographics that was happening.
And the technology was changing.
And technology.
People were going streaming things. Streaming was coming. It was in its infancy back then, but it was coming. And they didn't see that. And they saw it. They just wanted to ignore it and thought what they were doing was going to keep working.
Obviously, it didn't.
I think the last one is still in your hometown, Mike.
Their last Blockbuster store is in Bend, Oregon. Yes, indeed. 9,000 stores, completely gone.
Gone.
With the exception of the one in Bend, Oregon.
Yep.
And that's only there as one of those historical things.
But that's the investors wouldn't have seen this coming. I mean, they would have thought the store was probably going to stick around probably had more legs to go. But Netflix and they came in and their inability to see the future and buy it out. And there's a lot, the talk about spending money and like for long-term goals, taking the risk. And the companies that seem to invest and take that risk and see the long-term future pays off. Like we talked about Microsoft with their Azure cloud. They invested in that years before it was profitable.
Mm-hmm.
Like they put up like $14 or $15 billion. They didn't see a return on that for quite some time. But when the returns started to come in, it really started to come in.
You know, going to the Blockbuster story, you know, what you raised is really right. And for the people that were early investors in Blockbuster, they made a lot of money until they didn't. The stock went up, and then crashed. And you had to see that there was a change going on. You had to see that Blockbuster was not part of that change. And you had to get out then. It was figuring out a time to sell. And it's never the time when the stock starts to dive that you say, oh, should I be looking at this? It's a year or 2 or 5 years before that.
Yeah.
That you need to analyze and see what's going on.
I like to use the analogy like the coach of my New England Patriots, Bill Belichick. His philosophy is, I'd rather get rid of a player 2 years before he's done than wait till he's done, right?
Yeah.
So the guy goes to another team and plays well for 1 or 2 years, and then he's done. But you don't want to hold on to him till he's got nothing left in the tank. Nobody wants anything. You can't get anything for him.
Yeah. That's a tough story. That's...
In Seattle, that's a tough story, yeah. It is. But there's other stories like that. You know, like Circuit City's one where they did really dumb things. I mean, they had a good business. I remember Circuit City. I shopped there. I remember they had a good business model, kind of like Best Buy.
I remember going from Circuit City to Best Buy and Best Buy to Circuit City and to a couple other stores.
Yeah.
They had a good store.
They did. They had great salespeople. They had knowledgeable salespeople and knowledgeable staff. What they decided to do, management decided to do, was get rid of all their high-paid managers and get rid of all the high-paid salespeople and bring in people at cheaper prices, new people.
And for a time, that looks really good because you cut a lot of the cost.
Yeah, the stock will
profits go up.
Yeah, exactly.
Stock price goes up.
Till it stops going up.
Until it doesn't.
Yeah. So you can't sell the new people that came in that you bought them in at, 50 cents on the dollar to the old salespeople can't sell a computer if their life depended on it. And they don't study the products, don't know the difference between the product.
And we've all experienced that, whether it's Circuit City or another store where you talk to the salesperson and they really don't know what they're talking about.
They don't know. Yeah.
And if they try to blast through it by saying, oh, this and this is how it works, and you know for sure that it's not that way, you don't shop there anymore.
No, because you feel like you're being taken advantage of and they're just giving you a line. You'll go somewhere else where somebody knows what they're talking about. And you'll pay a little bit more. Mike. That brings me to the next story, Mike, that you and I know, is Radio Shack.
Yes, indeed.
Now, Radio Shack had a good business. For 100 years, they had the niche business of selling little knickknacks at high prices to consumers.
Yep.
They didn't have everything, but the stores were small, like a 7-Eleven. So you and I discussed, they didn't have a huge inventory problem. They had a return inventory. So you go in, the staff was knowledgeable. They knew what you wanted. They go find it on the shelf. You're in and out in 2 minutes, and you paid an extra $2 or $3 for it.
And it was something where it might sit on the shelf for a few years.
Mm-hmm.
That was the Radio Shack. You weren't trying to turn the inventory every 30 days. Costco turns their inventory in less than 30 days.
Right.
That's Costco.
But
Radio Shack might sit there for a couple of years. They didn't care.
But if you went in there with the problem, with the something that needed to be fixed, they'd spend time with you and help you fix things, and then you'd sell you a couple of things. Oh, you want this and this to go along with that? That'll make it better. And you'd buy 2 or 3 things because they spent time with you. What happened with them is when the cell phones started, when they went whole hog into cell phones, and they wanted to sell the phone, the chargers, the plans, everything. Well, then they realized that Verizon and AT&T and T-Mobile and Sprint, they opened their own stores. I don't need to go to Radio Shack. And Walmart was selling phones, and Target was selling. They tried to do what everybody else was doing, and they got crushed because they couldn't compete on a scale. Had they stayed with their core business of selling those components that might enhance the cell phone or whatever, they probably would be doing quite well right now.
Yeah, but they changed strategy. But for a while, the cell phones they sold added a lot to their revenues and some to the bottom line, and the stock kept going up and up.
And it looked like
until it didn't.
Right, and it looks like they're making the transition into the new technology, right? So, that's a good thing. It's not always a good thing to transition from away from your core, what you've been known to do.
It's important to track what happens with every company all the time.
It is. I mean, that's why, it's just on a couple funny notes, people who just do really stupid things. These ones are just, I put these in because they're so funny, Mike. You just can't believe how stupid some people are. But this is what happens when a good CEO of a business does something really dumb. But there was this guy, Ratner. They had jewelry stores in the UK, and he bought it from his dad. His dad could never really make any money at it, and he went into another business and realized that they were really hardcore sales, and they put their cheapest stuff in the front windows, and he started doing that. He went from like a couple stores in the UK to 2,500 stores. Really profitable. He was selling jewelry to all the working class, and he built a heck of a nice business. And then he went on to do an interview, and they asked him, how can you sell that tea set, that silver-plated tea set with the tray and the server and everything for £4.95? And he said, well, it's cheap. It's cheap, terrible stuff. The stock dropped like 80% the next day. They fired the board fired the CEO, took the company back. The company didn't go bankrupt. They changed names and came out and merged as another company. But it's just a funny story of how, I don't think this guy, not short-term thinking, I don't think he was thinking when he said, but just how he can destroy a company and destroy value just like that.
Well, and you talked at another time about Schlitz.
Oh, Schlitz is even funnier, but it's just like Warren Buffett says, right? It takes a lifetime to build a reputation and 5 minutes to destroy it.
Yep.
But Schlitz is really funny because they were the number one selling beer in the world in 1930. And then they had the CEO decide, well, let's cut some costs and add some adjuncts to the beer to make it more shelf stable. And the beer not only lost flavor, but it had no head. Nobody reported it was flat. So people, of course, abandoned it, right? Who wants to drink flat beer? And so they finally went back to their original recipe and started their original brewing process again. But then they came out with some really stupid ads that put them out of business. One in 1977 was, if you don't drink Schlitz, we'll kill you. It's an actual ad. They pulled it after 10 weeks, fired all the marketing people who put that ad together. But who approves these things?
Yeah.
And it's just funny how companies, can make these decisions. And we see, the controversy with Bud Light and stuff like that today. But who makes these decisions to make these shareholder value?
Those things happen. And I think there's a theme that goes on is the stock keeps going up, up, up until it doesn't. But by the time it doesn't anymore, you've already missed the boat. You should have been out a quarter, a half year, a year, 2 years before. Mm-hmm. You don't want to ride through a disaster. And the writing's already on the wall early on. You can see when Schlitz changed the formula, when Radio Shack decided to do cell phones. Mm-hmm. And maybe it would have been okay with cell phones, but you have to think about how all of that fits with what they were doing before.
Their core business was not going to be a one-horse pony selling one thing. They sold a million different little components into radios and CBs and all that stuff, and they had a niche market on that. And as I said, they were like a 7-Eleven. They were small stores that you could go in and get what you wanted with knowledgeable staff pretty quickly.
And their margins were really high, and people accepted the fact that you paid a lot more, but you could go in and find what you needed to find. Mm-hmm. And the people were so knowledgeable that if you say, I have this problem, they would say, oh, we can do this and this and this.
Yeah, I remember that. I remember bringing it. Oh, yeah, bring it in. We'll help you fix it. And help you fix it. And
yeah. The thing so important is to understand what's going on in a company before it tanks, not afterwards. So 2022 was a terrible year. One of the worst years we had at Adams Financial Concepts. It actually was worse than 2008. 2008, we were down 34%. 2022, we were down even more than that. And there were a number of factors that happened. It wasn't a reversion to the mean. It wasn't the fact that we'd been up 77% in 2020 or 45% the year before. It was not that coming back down to average price. It was a number of other factors that all came together at the same time and brought the stock prices down. But even as that's happening, there's a recovery going on. The first factor was inflation. We've been talking talking about inflation since 2016. We said for our clients, you need to have more money than you would think you need because inflation is going to take purchasing power down. And what inflation does is cost increase, wages increase, materials increase, even fixed costs get changed. Margins are reduced, profits are squeezed, earnings are reduced, and that happens for companies in general. Not every company, and it's important to understand which companies it affects more than others. But before the market in general understands, it takes a year or two before the impact is really understood. Silicon Valley Bank, we talked in an earlier section that when Silicon Valley Bank went, First Republic Bank went, and suddenly Wall Street was down on every bank. Every bank's going to fail. And you heard people talk, if you listen to CNBC or you listen to read some of the newspapers and articles, they talked about the weakness of the banking sector. And yes, the Federal Reserve said it's still stable and still good. But still, when you heard people from Wall Street, all they talked about was the commercial banks, the regional banks were going to go down. Didn't happen, hasn't happened, but it takes a while for all of that to work through. Inflation was the first factor. And when inflation set in, what happened is what is normal is the Fed began to raise rates to fight inflation. It's a standard response. In 1966, when inflation was growing, the Fed started raising interest rates. In 1921, after the Spanish flu, there was inflation, the Federal Reserve began to raise interest rates. The idea is to slow the economy, to make borrowing more expensive, to keep people from using their credit cards, to make banks tighten credit so that there's less buying. You want to force companies into some layoffs. They want to see less demand, layoffs, unemployment increases, and that further decreases demand. And people begin to reduce their spending on restaurants and cars and clothing. And once again, it's important to understand that doesn't happen to every company, but in general, it happens to most companies. It's a general thing. But until you know which companies it affects and which it doesn't, everything with a broad brush gets pushed down. Add to that the inverted yield curve. And most of the time when the curve inverts, the yield curve inverts, there's been a recession. And what that means is that long-term rates, 10, 20 years, are lower than short-term rates. The Federal Reserve is raising up short-term rates. The market sets long-term rates. And usually long-term rates are higher than short-term rates because people that hold bonds and buy bonds want to get an extra return for the risk they're taking for holding them so long. But in some cases, long-term rates go down because there's a flight to safety. And if you have a war going on, there's a flight to safety. If you have people expecting a recession, there can be a flight to safety. And so as the Fed was raising rates, you have the yield curve inverted and people saying absolutely 100%, we're going to have a recession, which is the fourth thing. And early in 2022, 99% of company CEOs, 95% of economists, and all of Wall Street said, we're due to a recession. Inflation's going, the Fed is raising interest rates, and we have this inverted yield curve. We're going to have a recession. First half of 2022, we're headed for a recession. Didn't happen. But stocks sold off because during a recession, stock prices go down. And they sold off in the beginning of 2022. And when it didn't happen in the first half, then the projection was it's going to happen and it's going to be even worse in the second half. And when it didn't happen in the second half, it'll be the first half of 2023. Well, we passed the first half of 2023, so it's going to be the last half of 2023. And it's going to be a really deep recession, or the first half of 2024. Because recession means that people are going to quit spending on vacations and restaurants and clothing. They're going to not buy cars. They're going to quit buying.
I don't know, Mike. I was at the game on Saturday, and there was like 150,000 Swifties down there. So I think she's driving her own economy.
They are. She expects to make $700 million from her tour.
Not bad.
Not bad. And people are spending that money. Anyway, I mean, the amount of money that people were paying for tickets. There's a story about a young woman who was trying to get tickets. She couldn't get tickets, but she could get a suite. It cost $40,000 for a suite.
Ooh.
She said to her husband, "What should I do?" He said, "Buy it. You'll be able to sell it." Sure enough, she bought it. And within a couple hours, she sold out. 24 people kicked in to buy
the suite. Oh, really?
The suite.
Yeah.
And they became best friends and making bracelets together and whatever else. But anyway, that's not what you see in a normal recession. But in a normal, because of people anticipating a recession, stock prices went down.
But the market, Mike, the job market we've been talking about, we're still 4 million workers short.
Yep.
And typically in a recession, we see unemployment come up. They said we need unemployment to hit 4.4%. Unemployment's done nothing but trickle the other way.
And we've been saying that. We've been saying that for 2 years. We do not expect a recession. People had stimulus checks, and so they had $3 trillion of money they hadn't spent. Mm-hmm. And they couldn't spend it because you were locked up at home, and businesses were shut down. Mm-hmm. So when the pandemic began to end, they could spend. They could buy cars.
And they've already bought travel. They already bought all the cars and all the merchandise that they wanted, right?
Yeah.
It was going to Swifty shows and going on cruises. We see the hotels in Seattle. What did you say to me earlier? They were occupancy even before Taylor Swift, 86%.
Yeah.
Full. That doesn't show a sign of recession.
And we didn't see unemployment kick up, which is a sign of a recession. Unemployment has stayed down. And in fact, more people are quitting their jobs. 40 million people quit their jobs, not layoffs. There have been layoffs. But most job changes were people quitting to take a higher paying job.
Yeah, I mean, you've mentioned it before, that starting with probably with Bush.
Yeah.
And probably with Clinton, actually, I think, was the Fed's goal is, keeping cost at 2% and full employment.
Yep.
Right. And even after the 2000 recession, it was keep cost. And then Obama did a good job of job creation. Trump did a good job of job creation. Biden's done a good job of job creation. And we see the unemployment rate keep trickling down.
And we have more jobs than we have workers to fill them. We've been saying that for 2 years. We've been saying what's been happening is now about 35% of economists are saying maybe we won't have a recession.
Even one of the biggest proponents of a recession was Jamie Dimon saying we're going to have a really hard recession, and then after a while he looked and said, "Oh, I don't think we're going to have a recession at all."
No, but during the first part, when you think there's going to be a recession, people sell out. In the early part of the program, we talked about things changing in companies and people not being aware of what's going on. And so stocks go up and then they don't. Mm-hmm. In this case, stocks get hammered down because everyone's afraid of a recession. There's no way to measure how much a recession is going to hammer a company. So you sell.
Yeah,
it was the perfect sell.
And then on top of that, the banks are like tightening lending standards, right? Yep. And so, but I don't know how much longer I can see them keep tightening lending standards when we don't see a recession happening. There's got to be some loosening of it.
So I was talking to the president of a bank where we do our banking, and he said they're tightening credit, but the people that it really hurts are the people without a banking relationship. Mm-hmm. Because I have a relationship. If we want to borrow money, we can do it on favorable terms. But somebody that doesn't have a relationship is going to pay 2 or 3 or 4% more, and they're going to require a whole lot more credit worthiness than I would.
Yeah, I got a friend who's a real estate developer, and he did the same thing. He said, no, I went to the bank. I said, well, they tightening credit standards on you. And he said, no, for me. He said, they're like, yeah, we'll give you whatever you want.
Yep. So if you have that relationship, it affects the people that don't have the relationship.
Yeah.
And that usually happens with a large bank, but that's another whole subject. But the whole recession thing, we've been saying, no, there's not going to be recession because there's an excess of jobs compared to workers. So that was a big factor in the beginning. Add to that, the world is at war. And, it was Russia that invaded Ukraine. It was something no one thought would happen. I mean, we haven't had something like this since World War II. We saw Syria and what happened there, but that didn't involve the world. Most of the developed world ended up in support of supplying materials, supplying ammunition to the Ukraine. And we're going to come back after this commercial break because that added some other factors to the whole thing. Don't go away. We'll be back right after this. So, started talking about Adams Financial Concepts and clients in 2022. We had a really bad year. It was not a reversion to mean after some very good years. It was 9 separate factors. We started talking about inflation, Federal Reserve raising rates, the inverted yield curve, the recession, all those things factored in. And then Russia invaded the Ukraine. And half the world ends up involved in that. It wasn't just 2 countries, but it was a real war that involved the United States, involved Western Europe. It involved developing countries around the world. And wartime is bad for stocks and it's bad for companies. And it's bad when you have a major oil supplier invading another country that is a major food supplier, because the Ukraine is the breadbasket.
All both of them with nuclear weapons, too.
Well, the Ukraine gave up the nuclear weapons.
The grain gave up the nuclear weapons.
Yeah. So you have a war with Russia cutting off oil to Europe, cutting off gas supplies to Western Europe, and the prices of oil and natural gas soared. And that affects all the cost. It reduces margins, it puts a profit squeeze, reduces earnings, and companies in general take a hit. Not every company, but a lot of them do, and it takes a year to determine the impact of inflation. And what we've seen recently is that OPEC has been cutting back production to maintain prices. We've been talking about peak oil for a couple of years. Maybe what we're seeing is it's happening, but that's another subject altogether. Energy getting hit also pummels stocks. And then the pandemic came to an end. And there's not a lot of history on what happens when pandemic ends. If you look back to 1919, 1920, 1921, Spanish flu killed 50 million people worldwide. Spanish flu was a huge pandemic. And when we came out of that, what happened? You had inflation. What did we have in 2022? Inflation. Mm-hmm. And what did the Fed do? It raised interest rates. What did we do in 2022? We raised interest rates. And what happened? You had a major recession. And what were people predicting for 2022? A major recession that they continued to predict was going to get worse and worse and worse until they began to say maybe there won't be a recession. All of that affects what was going on with companies. And finally, there was 2 other factors. One, some of the companies that we invest in have a path to earnings, but they aren't quite there because we're very early in companies. We try to be early because that's when the stock prices move the best. And so what happens during a recession? Companies without earnings suddenly find demand drops off, suddenly finds they're in deep financial trouble, and they cease to exist. We had companies that we believe had a path to profitability and which has shown that. And the final factor was we have concentrated portfolios for our clients. 8 to 10 stocks in every portfolio. And while most times the volatility is not any greater than the Standard & Poor's, during 2022, it proved with all these other factors going on, it proved that our volatility was much greater, both on the downside and now on the upside. We're seeing a significant increase. It takes time to sort out what's going on with companies. And as Al pointed out in the first part, when you're talking about these companies and being aware of what goes on, we track even when they're down. And when the stock prices are down, we don't panic and sell. We will sell if the fundamentals change. And that was the point you were making earlier in the program.
Yeah, if we see a fundamental shift in the direction of the company from management away from the core of what they are going to do, that signals that to us that they're not committed to what they're doing long term, and they're going for some short term gain or the long term goals of the company that they've outlined. That's why we bought the stock.
Yep. So it's all in understanding what's going on and digging deep and being sure of what we have and why we own it. There are times when I can tell you personally, it's like a white knuckles time, hanging on to the edge of the chair so tight with so much fear that the knuckles are turning white. You think, is this the end of what we're doing? And what I found most of the time is when it's a white knuckle time, that's one of the best times to be investing that there is. Mm-hmm. The easiest times to invest for most people are when the market's up. And if you look at our client list, you see the people that invested in late 1920 and 21, that their accounts have taken the full drop and have not yet completely recovered. People that were invested 20 years ago have not worried about it a bit. They've got so many gains that even a big dip doesn't get them anywhere close to where they began. That's understanding how all of this goes together. It's understanding where the companies are, what's going on within the companies during good times and bad times, not being worried about whether a company misses the earnings at any time. And what we saw in 2020 is when a company missed earnings by 1 penny or 2 penny, they were expected to report $1.31 and they reported out $1.29. The stock price falls 20%. Mm-hmm. I mean, it's absolutely crazy what happens.
But we had stocks like this reported good earnings, good sales, as I said before. Solid fundamentals, and as you said, we're in early, so they're not profitable yet. But the stocks got tanked 20%. It's because they gave a not pessimistic, but just a we're not really sure about the the next quarter or two what's going to happen, right? I mean, they're just being realistic. They're showing some realism, and the stock gets tanked for showing that there could be some turbulent seas ahead.
And when you're the CEO of a company, if everyone is saying we're headed for a recession, you may believe it or not believe it, but you better prepare for it. And mm-hmm. And they do prepare for it.
Yeah.
If it doesn't, it's like planning for the worst, hoping for the best.
Yeah, that's exactly what this guy was doing. He's like, hey, we could have a couple of quarters where things are off a little bit, but we're planning for that, and we long term. This is what we want to do.
And
so I'm good with that.
I am good with that too.
And the stock drops 20% because of that. I'm like, I'm good with that. I'm okay.
Yeah, I'm really good with that.
I'm just going to go buy more.
That's what Peter Lynch said. If you can't convince yourself that when a stock is down 25%, I'm a buyer, and not that when a stock is down 25%, I'm a seller. If you can't convince yourself you're a buyer, you'll never have better than mediocre results.
Howard Marks put it great in his last memo. He said, we don't buy stocks waiting for them to be cheaper. If we see the stock is cheap, we don't say, well, in 6 months it's going to be cheaper. We go in and we're going to buy. And if in 6 months it's cheaper, guess what? We're going to buy more.
In most cases. There are cases you just say, oh, we made a mistake and move on. Anyway, that wraps us up for this week. Have a great weekend, a great week, and we will be back next Saturday to talk about money. On the radio station, The Answer, we have the answer about money. Join us.